Welcome to our CFP Exam Prep podcast, focusing on a crucial taxation topic that often appears on the exam. Today, we're diving deep into the classification of assets and their tax treatment, specifically looking at capital assets, Section 1231 assets, and ordinary income assets. Let's start with capital assets, which represent the broadest category. These are assets held for investment or personal use, such as stocks, bonds, personal residences, and collectibles. Many candidates make the mistake of assuming all business assets are capital assets, but that's not the case. Capital assets are actually defined by exclusion. They're everything except what's specifically listed as non-capital assets in the tax code. A common exam question involves identifying the holding period requirements for long-term capital gains treatment. Remember that assets must be held for more than 1 year to qualify for preferential tax rates. The day you acquire the asset doesn't count, but the day you sell does. For example, if you bought a stock on March 1st, 2022, and sold it on March 1st, 2023, it would still be considered a short-term holding. Moving on to Section 1231 assets. These are depreciable property used in a trade or business and held for more than 1 year. Think of items like manufacturing equipment, buildings used in business operations, or commercial real estate. Here's where many test takers get confused. Section 1231 assets have a unique tax treatment. Net gains are treated as long-term capital gains, but net losses are treated as ordinary losses. This gives taxpayers the best of both worlds. A practical example would be a business owner selling two pieces of equipment. One generates a $10,000 gain, and the other a $6,000 loss. The net Section 1231 gain of $4,000 would receive favorable capital gains tax treatment. However, if the loss were $12,000 instead, creating a net loss of $2,000, it would be treated as an ordinary loss. Ordinary income assets are the third category, and they include inventory, accounts receivable, and property held primarily for sale to customers. The most tested concept here is inventory, especially regarding dealers in securities or real estate. Their holdings, even though similar to capital assets, are treated as ordinary income assets because they're held for sale to customers in the ordinary course of business. One of the biggest mistakes students make on the exam is misclassifying rental real estate. If you're a landlord renting out properties, that's typically Section 11231 property. However, if you're a real estate dealer regularly buying and selling properties, those properties are ordinary income assets. Here's a key point that often appears in tricky exam questions. The same type of asset can fall into different categories depending on its use and who holds it. For example, a single piece of real estate could be a capital asset if held for personal use, a Section 1231 asset if used in a business, or an ordinary income asset if held by a dealer. Remember these distinguishing characteristics. Capital assets are held for investment or personal use and receive preferential tax treatment when held long-term. Section 1231 assets are used in business operations and get hybrid treatment. Ordinary income assets are held for sale to customers and receive no preferential treatment. Study these concepts thoroughly and practice identifying assets in different scenarios. The exam frequently tests your ability to properly classify assets and understand their tax implications in various situations.